it's almost like you have to look at it from two perspectives. Okay, well, yes, I could look at what's good for the business and then what's actually good for me personally. Because there are some situations where you can make a tremendous investments into the business and make it more valuable, but from the personal perspective, you might not be that much better off. And so that analysis is kind of key to, especially if someone has full control over the business and about what they're going to do going forward.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why? Hi, everyone. I'm Jason Balara, and this is the Know Your Why podcast. Today, I'm here with David Flores Wilson, the co-founder and managing partner at Sincereus Advisory. He advises entrepreneurs and business owners in New York City on personal financial planning issues from formation to exit and beyond. David, as I mentioned, I like to really let you tell your story and your background and so we'll get to that. But first, I want to say thank you for taking the time out to chat with me. Thanks for being on the show. I appreciate the time very much.
Yeah, great to be here, Jason. Looking forward to the conversation.
Awesome. Well, let's start with that. Let's start with your background. Tell us a bit about yourself, what brought you to where you are today, and then we'll dive in.
Sure. Currently I have a wealth management firm that advises entrepreneurs, and so my personal origin story started when I was a kid. My parents were divorced, and my dad was a CPA, and so I got little bits of sort of financial literacy at the dinner table, and then on the weekends I'd spend time with my mom's family, which they were business owners, and they had a series of businesses that I would spend a lot of time kind of working in, weekends, summers, and things like that. And so for me, what ended up happening is they made a lot of bad decisions when it came to their personal financial planning. They lost one of their businesses because they didn't have the right coverages. They didn't have the right estate plan in place, and so I work to sort of help that make sure that entrepreneurs don't make those same mistakes. Mm-hmm. And that's what kind of drives me when I'm kind of giving that advice, because a lot of times entrepreneurs they don't have that objective advice, right? They're the boss. They have a lot of control over what happens, and so just being part of that team and giving them that objective advice to kind of advance the plot, right, of their financial lives is super important to me. So
yeah. So I do find a lot of people on the show are some level of motivation from past experiences, whether that's themselves or family or what. You don't have to give specifics about your parents' situation or anything like that, but I would be interested to kind of understand what some of those mistakes that you see commonly, what are those kinds of things that, because I feel like it's probably easy to get into that as an entrepreneur, and I guess maybe selfishly I'm probably making some of those mistakes, and I'm trying to figure out where I need to fill in the holes. But talk a little bit about kind of what those mistakes might be, what people can encounter.
Yeah, I think we can even just start at the formation of a business, right? And I think that when people start a business, they might go to their lawyer, and the lawyer's like, oh, you should be an LLC. That's the most flexible. Their CPA might say, you know what, you need it to be an S corp because you can save some FICA taxes when you do that. And they might have some friends that are venture-backed company owners, and so they're like, okay, well, you need to be a C corp because that's what investors want. And so I think that people always sort of need to take a step back and understand the lens of sort of the advice they're kind of being given, right? And kind of get these different people in the same room. Because, for example, if it's a business that they want to sell and it's a fast-growing business, they might want to be a C corp because there's a quirk in the tax code that allows for a $10 million capital gain exemption when they sell the business. It's called qualified small business stock, QSBS. And so when you think about that and you start with the end in mind, you're going to avoid making mistakes, right? And so you might start the business in one entity type, for example, an LLC, and that way, there's a lot of losses, in the business, and you can kind of capture those losses from a tax perspective. And then you can switch and say, hey, you know what, I think this is going to be growing pretty quickly. And so we can switch to a C Corp, and that way we can have a huge exclusion on the capital gain when we do sell it. So I think it's really about sort of like the mistake I see sometimes is that, they're just, you need to kind of get people in the same room, right? You're kind of different advisors because they all have their sort of, their training and their specific perspective. And so, having that sort of healthy debate and starting with the end in mind, right? Say, well, how am I going to exit this business? And so I think that's why, even you're sort of 5, 10, 20 years away from exiting your business, like you have to kind of think through some of the what ifs around that, from the get-go.
Yeah. I mean, it's funny you say those examples of the lawyer says this, the CPA. Yeah. I've heard literally all those things exactly, like from exactly the parties that you're talking about. So it's, those are, I think that just speaks to, that's probably a pretty common experience that people are having in their entity formation. I wonder if you would, I have personally really relatively recently heard about the QSBS. Is that right? Will you explain that just a little bit? For me, but also, people listening, just to kind of understand, because I do think that's a fairly important piece of the puzzle that I have heard people didn't know about it, that, and so I think that there's it's an important tool that could be used. Maybe it's not applicable to every case, but I wonder if you would just dive in a little more on that.
Sure. Yeah, so I think that basically you can get this sort of $10 million capital gains exemption, or 10 times your basis, for example. Your basis is your tax basis, essentially what you've put into the business. Mm-hmm. And so there's different requirements to qualify for that. You have to be a C Corp. You have to have held those shares for 5 years, and it has to be a specific type of business. Service businesses don't count, like the business I have. And so if you hold that, and then they have to be primary shares as well. And so if the business is sold after 5 years and it's qualified small business stock, you could have, let's say, sell the business for $20 million. You have a $10 million capital exemption, and then you sort of pay the capital gains only on the 20 minus the 10, or the $10 million. I think what a lot of people don't know is that there's different strategies to sort of maximize that exclusion, right? So, for example, if a very attractive sale offer comes in, but you've only held the shares for 3 years, you can roll over the sale proceeds from that sale, because you haven't qualified for the 5-year exemption. You could roll it into a new company that's also QSBS. And so, and so you can imagine sometimes as well, there's other ways to multiply the exemption, right? For example, there's a weird quirk where if you give a portion of your shares to a family member, maybe you're a child through a trust or a parent, then they also qualify for another $10 million capital gains exemption. And so, this strategy is essentially called stacking. And so if you sort of set up, let's say, you have 3 kids, you set up 3 trusts for one for each, and you kind of hold some of the shares, and then the business is sold for $50 million. You have a $40 million capital gain exemption, because there are 4 entities, 4 taxpayers that have that qualify for the exclusion. And so, there's lots of different strategies like that. And so I think, working with, the right planner and a CPA, as well as, sometimes, of course, the attorney, because there's the flip side to every strategy, for example, right? Do you really want to, have your kids through a trust have that much wealth if you know that the business is going to be sold, right? And so, just kind of weighing those pros and cons, or, for example, if you're sort of 4 years in and you've got a great offer on the table for the business, what's the break even between, paying the tax after 4 years, or waiting and taking the risk that, that offer will be around after you actually qualify in 5 years. And so lots of different strategies for there.
Yeah. You said it doesn't count for service industries. That I had not heard before. So is that every service in, I mean, how does that, how do you break that down?
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
Yeah, so there's, to be honest, the businesses that don't qualify are actually the same businesses that don't qualify for the the section, what's called the pass-through deduction after certain thresholds in the Tax Cuts and Jobs Act of 2017. And so I think that I might be butchering this language, but it's businesses that don't rely on the skills of the owner, right? And so you can imagine a law firm, that's predominantly, of course, the skills of that owner, or financial advisory firm or a consulting firm. I think the goal really, when Congress sort of in the early 90s first put this into law, is to grow the economy, to promote job growth. And so you can imagine, I just opened up a financial advisory firm. I would have done that anyways, right? And so oftentimes it's companies that are software, or they're creating some sort of product that qualify. And so and there's specific carve outs for other types of business, like for example, hotel businesses don't count. And so there's the code isn't that long, but I think it's as well you have to sort of the spirit of the law is that you're sort of promoting job growth. So you can't exactly start a C corp, raise a bunch of money, and then and not have a real business. It has to be a bona fide business. Right. That's a non-specified service business is called. So.
Okay, great. Thank you for that explanation. I like I said, for that topic I have heard a few times recently, and it just piqued my interest. And then you mentioned it, so I figured worth diving in a little bit.
Yeah, I think one other thing I think it's interesting because there's a lot of tech companies that of course would here in New York City there's a huge technology high growth infrastructure here, and so and a lot of these companies will give stock options to, for example, their employees to incentivize them, and it actually doesn't count to start the clock until they actually executed those stock options, right? And so sometimes it's like, hey, you're going to execute those stock options, and there's going to be a taxable event. But it starts the clock. And so there's, some pros and cons to all these different strategies.
Gotcha. Yeah, I'm sure. I mean, exactly the point here is that you want someone there as an advisor to help you kind of figure out whether or not this is right for you in your business and all of that. So, what other mistakes? I mean, so we touched on entity formation. What other things have you seen where you've had to, kind of come to people's aid?
Yeah, I mean, in sort of the vein of exit planning, I think, is that sometimes we talk to so many business owners, and they're sort of like, oh, I want to sell my business in 5 years, right? And so 5 years passes, and it's like, oh, I want to sell my business in 5 years. And so we really think it's an amazing thing to really embrace exit planning, and not just for the sort of exit event itself, because it's actually just good business, right? Because when you kind of go through the exercise of getting sort of financially ready, personally ready, and getting the business ready in terms of and making the business more attractive, you're going to end up with more flexibility, greater options down the road, as well as just a more valuable business. Right? And so the classic case is we see the business owners, kind of they have 3 or 4 roles within the business. They're kind of the CEO role, they're head of sales, they're looking at the books, and then I think that's not a business that an outside buyer wants to come in and buy typically, right? Because then they're going to have to sort of create a management structure and and create sort of like systems and processes to make the organization function. And so if business owners can embrace that sort of process of getting financially, personally, and then getting the business ready, then they can be much better positioned down the road. And I think that also business owners just have so many personal biases. For example, like if they maybe talk to their friend, or they did an ESOP, or they sold to private equity, or they did a succession internally, and so I think oftentimes they have a sense of these kind of different exit options. And so, but really clarifying the why and the structures and the implications, because it really is about who's important to them and what who the stakeholders are and what they really want to accomplish, right? Because if they want legacy, well then they probably shouldn't sell to a PE firm, right? Because a PE firm is going to probably aggregate them, erase the name, and then kind of move on. But other structures and other sort of exit options could do that. And so, just really teasing it out and really understanding, okay, what are they really focused on? And then that way they can kind of get ready for that eventual exit option.
I think obviously the best time to start thinking about this stuff is at the beginning, right? Like you're like you said, we talked about entity formation and things. Yeah. If suppose someone has, they have their business and then they start to think, oh, I'm retiring. So basically they've reached the point of thinking about exit. I mean, how far in advance do you feel someone should be really, really truly prepping for that exit in an aggressive fashion to try to really maximize what they're able to get at exit?
Yeah. Well, I mean, in an aggressive fashion, it's sort of 2 to 5 years before they want to exit. But I do think that they, whether it's 5 or 10 or 15 years before, there's definitely things that they can implement to run a better business, right? So I think that thinking on the personal side is super important, right? Because so many business owners, they sell their business and then they regret that they did that, right? And so they just weren't ready from a personal perspective. And so, what are they going to do with their time, right? Like, what's their sort of purpose once they sell their business or exit their business? What's their identity? And so, we're talking about people that are highly focused and they really love what they're doing. And so, and then one day they kind of wake up and they're like, okay, well, I don't have the business to run anymore. And so they have to, to really kind of know what they're going to do ahead of time. And so, whether it's running through all sorts of different exercises. Okay, well, let's do a model week, right? Let's say what would you do with your time, right, like Monday through Sunday, right? So, you tell me you love playing golf and you want to spend more time with the grandkids, but what about the other 110 hours of the week are you going to be doing?
Right.
So,
right, yeah.
You go to a party and you introduce yourself and you're like, oh, I'm a business owner. I did, so what are they going to do? How are they going to sort of frame who they are, post-transaction or post-exit, in terms of that's such an important component of that process.
Yeah. I mean, that makes so much sense. It's interesting because, been in real estate for a while, and then over the last year or two been looking at potential business acquisitions, and the differences are pretty stark when it comes to some of the stuff you talk, like the personal side of a business transaction. It's much less, I think, real estate. Yeah, I mean, I think if people are, selling their childhood home, maybe that's like a more emotional thing. But I mean, the analogy I've used in just from my experience on the trying to be a buyer is it's almost like they're selling a child, like that. There's that much of a emotional connection and investment of life and time that it's an entirely different. I mean, in a way, I like it better. I like that, idea of having that, sort of personal connection with a business seller, but at the same time, it creates a lot of complexity in making those deals happen, because like you said, some of them, they sell their business and then they regret it. Well, some of them figure that out before they sell their business and decide, yeah, I don't want to go through with this. And so it's like things happen because of the kind of emotional side of this. So again, like I'm sure you deal with a lot of almost like counseling role, therapist sort of role.
Yeah, I hear you, right? And I think you're touching on something that is so common, right? And you kind of get to the goal line almost, and they're getting cold feet because they just really, they haven't really fully embraced what's going to really happen. Mm-hmm. It's been so focused on the transaction, or let's face it, business owners are pulled in so many different directions. They're busy as they're kind of juggling their role as owner and managers, and so it is this. We see it again and again, right? Because this emotional connection to the business is so strong, and so whether it's they heard their business is worth X 10 times EBITDA, right? And so and they're like, well, I put so much time and effort in this. I love my business. Like mine must be worth 12, right? And so you can get to sort of the negotiating table, and there's a discrepancy in the value that the market will pay and what they believe their business will be worth, right? And so that's a big part of the exit plan. They have to sort of understand, okay, well, if that business really sold for 10, why is that? Do they have lots of systems and processes in place? Is it a developed management structure? Do they have a system of developing leaders and a sales funnel that's automatic, and all the sort of risks around the technology and the legal side are mitigated. And so I think that when business owners sort of address this earlier, then they can get more comfortable with how much their business is really worth, and then also like, okay, well, if they make these changes, it'll be worth more. And so so that way you don't sort of get to the negotiating table. They kind of walk away because of cold feet, or they realize like, oh wow, like, what am I actually going to do? Monday through Friday, or Monday through Sunday, kind of thing, right? So, well,
yeah, I mean, so that really your job is often, I'm sure, to deal with a lot of the emotions involved with it, and it's a kind of a long-term relationship building sort of thing. If you're looking at a minimum 2 to 5 years from exit coming in to try and help people prep for that. I mean, it's not like, oh, I want to sell. You're not a broker. You're trying to get them to be ready for that step.
Yeah, I mean, it's happened a few times where business owners have come in and they're like, I want to sell my business in 6 months, and I'm like, there's not much I can do. I think there might be other advisors that can kind of parachute in that situation, but I just know that it's going to take a series of sprints, right? We're going to have to address this, and then we address that, and then you're going to get busy. You're not going to have time to sort of do this, to implement some of that we talked about, and so that's sort of a different process, right? And so where you can't kind of focus on anything, but yeah, I mean, there's different areas, and the various barriers to exit planning are kind of all over, right? The sort of resistance to change, you talked about sort of the emotional connection. It's overwhelming, right? And so our job sometimes is to go in and say, hey, like, to make it a little less overwhelming, to start small, maybe we start with the sort of the financial readiness piece, maybe just try to understand what their expenses are, even something like that, where they don't understand the rate of return within the business, and what they're really spending. And so as they're sort of running through potentially sort of quasi personal expenses through the business, trips, company car, and then sometimes they realize like, oh wow, actually I'm spending a lot more, and so I'm going to need more money if there is an exit event. And so then we'll sort of bring consultants in and say, hey, like, if you need to get to this higher valuation, what are some of the levers that we can pull, and some of the people we can bring in to make it more valuable, right? Because I think that some of the things are pretty standard, right? Like, how do you get more of the revenue recurring revenue? How do you make it more of the revenue diversified? How do you get, frankly, size is a big deal, right? Like, even in our business in the financial advisory space, right? You trade for, you might be trade for X times EBITDA. If you have a couple $100 million under management and you sort of have a couple billion, then, well, yeah, it might be like, 15 or 18 times EBITDA. And so just even the size itself, maybe they actually want to do an acquisition, right? So that they can actually get a better multiple. And so all those sort of permutations really need to, thought through. And then of course the structures, right? Like, when the transaction happens, there's so much going on. And, there are people kind of coming out of the woodwork and say, hey, you should do this structure, you should do that structure, like save money on taxes by doing this charitable structure or this unique structure over here. And so they really need to understand sort of the spectrum of options ahead of time. So that way, they're like, oh, no, I already know about that structure. It's too aggressive from a tax perspective. I'm going to stay focused over here. And so, the sooner they kind of understand those things, the better off they're going to be when it actually happens, because it's just such a stressful time, right? When the actual transaction is coming up.
Yeah, for sure. I mean, you sort of brought this up. I would imagine a lot of it depends, and maybe you only work with specific business sizes, but I would, imagine a lot of the things that you talk about are very business size specific, because, you mentioned some of the multiples, and it's like, if you have, 500,000 of EBITDA versus 2 million of EBITDA, like they're going to trade for different multiples, but also they're going to have probably different levels of management structure in place. And that's why they trade. So it's like someone who's got 500,000 of EBITDA, you might not be able to say, well, if you put this management team in place and upgrade, like they'd basically drop all their profit away and then have to sort of like build it back up to meet that. So do you, maybe comment on that, but I just for the listeners who are, might want to consider working with you, you do have a business size that you kind of focus within.
Yeah, you brought like an interesting point, right? Like it's a push and pull in different directions, right? You're like, okay, well, I can get more size, I can get more infrastructure, but then my EBITDA goes lower. And so oftentimes when it comes to these businesses, you're managing sort of the change in the growth rate versus the actual profitability, right? And so you can rein in profitability if the investments that you make results in more growth. Right. And so I think that's an interesting push and pull. And that's where, there's a big education process. It's kind of, okay, well, a lot of times, like, anyone who's ever reached out to you to buy your business in the last 5 years, early in the process, maybe even sort of, 2 or 3 years before you sell the business, is that let's get them all on the phone, right? Let's get them one by one to say, what do you like about this business? Mm-hmm. What would make it more attractive to you? What would make it less attractive? And try to understand from the buyer's perspective a little bit more. And when you kind of, you do all those sort of calls and that sort of, preliminary due diligence on the potential buyer base, then, we can make potential changes in the business. And so, for me, the vast majority of businesses we work with, they're either sort of in the technology space here in New York City or California. We work with a fair number of multi-generation family businesses. And then as well, some of these businesses that, have professional service, they're pretty profitable professional service businesses, marketing agencies, recruiting agencies. And so there's a little bit of push and pull there, right? Like okay, wow, I can make a pretty good income and just cruise. Or I could make investments into the business and increase the value, but then I'm going to make less income. And so it's almost like you have to look at it from two perspectives. Okay, well, yes, I could look at what's good for the business and then what's actually good for me personally. Because there are some situations where you can make a tremendous investments into the business and make it more valuable, but from the personal perspective, you might not be that much better off. And so that analysis is kind of key to, especially if someone has full control over the business, like about what they're going to do going forward, for sure.
Yeah, it is. It's kind of a fascinating study in human psychology in this process, and in like one of the other things that I've noticed is the most, at least the businesses I've looked at, most of these sellers they've owned the business for a long time. They have no debt on it. They're probably like, that EBITDA is like literally cash flow to them. So like they're making very, very good money out of that business. And so you sort of touched on this before, but it's like, okay, so if I sell this business, and if I had a $1 million EBITDA and I sell this business for 5x and it's 5 million, like, so I have if I want to live at the same lifestyle, like I have 5 years basically, once I don't have this business income coming in anymore. And so it's kind of, I think to me, it all just points to the importance of understanding these concepts and implementing some of what you do early on, like before you even think about that exit, because you have, we just talked about sort of the investments you're going to make in the business, making those investments early on to fuel growth. You're going to feel that a lot less than, hey, I want to sell in 2 years. If I drop my EBITDA down, my sale price is going to be lower. And so then it's like, well, I'm not doing myself any good by doing it at that point. I think a lot of it comes down to that like sort of long-term investment in whatever your exit plan is.
Yeah. No, and it's really about their goals and running the numbers, and to use your example, okay, I mean, if you're collecting $1 million and you can only sell for 5 times, okay, 5 million, and then I kind of take that pot of money and I kind of, there's a sort of safe spending for the rest of your life of 4% on that. Well, then, okay, well, like I'm gone from $1 million a year to 200,000, right? And so, but maybe there's other things that can be done there, right? Like maybe that business, has a large real estate expense. And so over time, maybe purchasing the office or the plant and then renting it to that business makes sense. And so, hold that through a separate entity for asset protection perspective. And that way you can sell the business, and then you also make, potential investments and grow that EBITDA from 1 to 2 or 3. Sell the business, and then continue to collect the rents on the property that you bought with the cash flow prior to selling the business. And so then you've kind of like but I think a lot of business owners know that okay, like if they just continue this as long as possible, they'll sort of build up that outside wealth. And but some of them, they care about the management team and the employees and the legacy of the business, and so they know that they haven't put those systems in place, then they're going to squeeze a lot of wealth out of the business along the way. But then the business itself will not continue. And so just really, and that's okay for some business owners, and it's really not for others, right? In terms of the impact on the community or the business has and other things.
Yeah. It is it's a very interesting space, and I think what you're doing is, I mean, just like incredibly important and valuable to those business owners that are looking to exit. I mean, ultimately you're likely you're always going to exit, right? Somehow you're going you're going to exit.
Exactly.
There's some way to, even if this is like, oh, it's going to be something that I hand down to my kids, like I'm sure there's a lot of strategy that goes into setting up for that and not having them, hit with a huge tax bill or something like that. I mean, all of this stuff is just, it's financial literacy and planning and everything important in all spaces, personally, as well as through the businesses that you might own, but that there's just a lot more complexity probably to it on the business side to sort of how it all ties into everything else.
Yeah, no, it's a lot of fun. I think entrepreneurs and business owners, they're so dynamic in terms of their situation, right? And I think one interesting piece is that it almost doesn't make sense to have that conversation with the business owner without the spouse as well, right? Because you kind of get the perspective of the spouse and kind of what are their goals, what are the family's goals, and oftentimes that spouse needs an advocate. They see the business owner putting in the long hours, they see that they want to be doing other things, but they just don't have the the plan in place to implement that. And so, really understanding, okay, what does the family want to do? Particularly family businesses as well. Like there's so many different nuances and dynamics when it comes to the family business, right? In terms of, very few family businesses like make it to that third generation. Mm-hmm. And the ones that do, it's super important for families to be intentional, right? Do they want, that next generation to receive it as a gift? We're working with a family that, the CEO received the shares as a gift, and she wants to do that to the third generation. And so it's super important that she builds up that, that financial freedom outside of the business. And so there isn't any sort of pressure on her financially when she sort of, gives the business to that third generation over time. And so, and all sorts of different structures that can be done, right? And so, right. As well, what is that process to take that family member from someone who's, might be interested in the business to someone actually that can run it one day, right? In terms of their personal development, and having it be sort of like a two-way street of like, okay, well, the business really needs that third person, that next generation to come in the business. And then they actually want to be in the business a lot, right? And so it may make sense, like, okay, well, after college, it may make sense to go work somewhere else, like, build up your skills and your confidence and add value from a career outside the business, and then kind of circle back and then have very specific goals and guidelines around entering the family business. And then what do we do about, okay, well, you have a couple siblings and one wants to be in the business and the other doesn't. Like, well, are we going to be do we want fairness, or do we not care about their involvement in the business? And so it's just all sorts of different permutations and sort of approaches. But I think you can oftentimes in a family business, you can almost anticipate some of the potential conflicts, and if you're able to address them early, there's going to be so much better outcomes than if you don't.
Yeah, I mean, even just as we speak, that the number of different factors and considerations and things like that can come up, and family businesses in particular, is I'm sure that is in some ways daunting, but also kind of, I mean, you can get very creative, I would say, in terms of structuring and as you are someone who understand all of the different nuances and ways you could take it, like that's what people need, again, to like navigate through these situations of, okay, 3 kids, one of them wants to be involved, the other 2 want nothing to do with it. How does that look? Like all of these things that can come up, and it's just, again, points to the value of what you do. So thank you for kind of sharing that and breaking that down. And I'm sure people who are interested, there's a lot more that you can give them and sort of help in that process. So David, I want to make sure we have time. I always ask every guest, what is your why? I think that's, title, that's an important piece of this. I think it often ties into the conversation in a lot of ways. And I think what you do is providing a very valuable service to people. But what's your why, from your perspective?
Sure. I mean, the why for me is about impact, right? I think we touched on this a little bit, that financial literacy in this country, it's just really not, there's a dearth of financial literacy education, primary school, secondary school, and college. And so it's my personal mission to make an impact on that, right? And so, whether it's, being on a podcast like this and kind of sharing some of the concepts, or, the content that we put together on the blog, Planning to Wealth, I think that's my why, so people can have better outcomes for their family, particularly with entrepreneurs where, we work with a lot of different people, but, when the advice is good and they're sort of advancing the plot, it's not just their family, it's not just them, but they also have a community that they support, and employees and their management and their stakeholders, the customer and supplier level. And so that's my why, is that, just to have those better outcomes through financial literacy, for sure.
Yeah, it's incredibly important, and it honestly something I didn't, for much of my life, didn't understand how lacking the education system is in this area. And it's like we could spend a lot more. We could help people a lot by spending a lot more time on this in their schooling. And so I think again, what you're doing is just so valuable to people and their legacy, and probably saves some family dynamics, and it really just kind of important in a number of different ways. When people hear this and they want to connect, what's the best way for them to reach out to you?
Sure. If you just Google David Flores Wilson, they can connect through our website and set up a call. As well, take a look at some of the blog information around these sort of business financial planning topics, or just connect on LinkedIn as well.
Okay, great. Well, we'll make sure we have all of that in the show notes. David, thank you so much for coming on the show and sharing all of this. This stuff's really fascinating to me. I love just kind of getting in there with you and talking about some of these topics that I think are, like I said, so important. So thanks again for being here and for sharing all that you did.
Thank you so much. Great chatting with you, Jason.
Folks listening, make sure that you connect with David, and please like, rate, and review the show so we can continue to get more great guests. Thank you all for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?